So tell us a little about your portfolio. Why so few names?
So for a bunch of reasons. I mean, I've always had the view that, why not own the best 10 or 11 investments as opposed to ideas 12 through 25 or 12 through 100, which is more typical. And, I think there are very few great investments at any one time. So the ability to concentrate is an enormously valuable asset of a strategy. The problem with it is it leads to bumpier returns. And it leads to more attention on mistakes or things that aren't going well. I don't know a portfolio manager that doesn't have a stock that's down in his portfolio, right? But you don't read articles about. We're getting an awful lot of attention for a pretty high-profile situation that's struggling. But I think there's. It depends on what your business model is. But if you want to make high rates of return over a long period of time, it's hard to do that being very diversified. I mean, if you look through the Forbes 400, wealthiest people in the world, most of them made their fortune in one business or a portfolio of two businesses. Very few made it in a portfolio of 100. So it's that. And the other benefit, it allows you to run a much simpler investment firm. We have an 8-person investment team. If we had 30 names, we couldn't manage that portfolio the way we do with a small team. By having a small team, you can hire better talent.
There's actually an argument that some people are now making that, buying the index or buying diversified funds have had much better returns than buying, those hedge funds that have, a very specific smaller portfolio approach like yours.
I haven't seen that article. I mean, I think we've done very well relative to any index alternative, certainly. So, it depends on how you judge us. I think if you judge us on a 90-day basis, I have no idea how we're going to do relative to an index. But I think this is a strategy that over time should earn a meaningful premium over, any kind of benchmark, or you shouldn't give us your money.
Yeah. And usually this investment philosophy, does it take a week, a month, 3 months to do the research, a year? I mean, you have 10 names. How long?
It depends. I mean, one of the best investments we ever made took us 4 hours to do the work. It was during the financial crisis.
Which was that?
Wachovia Corporation. Okay. So I was on my BlackBerry eating breakfast at the Brooklyn Diner in front of my building, and there was a story went across the. I was just, Wall Street Journal headline, a Reuters headline, excuse me, went across saying that Citigroup to acquire the Wachovia banking subsidiaries for $2 in Citigroup stock. Stock was halted. And this was kind of an interesting transaction because they were buying the subsidiaries for Citigroup stock. I figured, that's interesting. What happens to the holding company? So I went back to, kind of went upstairs to the office and, cracked open the 10K and another member of the team, Mick McGuire, he and I worked on it. And what was interesting is the 1,000-page 10K of Wachovia Corporation, I think 900 pages were on the banking subsidiary. There was fewer than 100 pages on the holding company. And by buying the banking subsidiary, Citi was leaving a holding company which had cash, in Wachovia Securities, A.G. Edwards, they had paid $6-7 billion for it 6 months before, Evergreen Asset Management, and they were taking a $27 billion loss on the sale of the subsidiary. And it also had a liability called non-cumulative perpetual preferred stock, which if you ever want to have a liability in your life, this is the single greatest liability to have. It's a form of equity where you never have to pay a dividend, and when you don't pay them, they don't accumulate. And the worst case is they get a couple of directors on the board, and you say hi to them each meeting, and you have this very. I said, look, this could be our Berkshire Hathaway. And at the end of the day, we figured the asset. In 4 hours, we determined the holding company was worth at least $11 to $14 cash, a tax refund that you could carry back the $27 billion loss, recover cash taxes that have been paid. So you have this cash vehicle. You own Wachovia Securities, which is a good wealth management business. Mm-hmm. You own A.G. Edwards, another interesting asset. These are businesses you know well. And the stock opened after it was halted at $1.84. So we said, look, it's worth 11 to 14, $1.84. We bought 42% of the volume for the next 4 days.
Charlie and I have circles of competence that extend to evaluating a number of types of businesses, and there are a whole lot of businesses that we won't be able to evaluate. Some of them I think very few people can evaluate. I mean, you get outside of, you just get into businesses where the future is so likely to be different than the present that maybe there's a few people who have great insights on it, but we sure don't. We are best at the businesses where we can come to a judgment that they're going to look a good bit like they do now, 5 years from now, 10 years from now. They'll be bigger, they'll be doing different things, but the fundamentals will be the same. This car will be a bigger company 5 years from now, maybe a much bigger company, and we may get a chance to do interesting acquisitions. But what you saw there, the fundamentals won't change. The way the people think won't change. I can name a number of businesses that are bound to change dramatically. I mean, when you think of how much the telecom business, for example, has changed over the last 15 or 20 years, it's startling. Even with hindsight, it's a little hard to figure out, who was going to make all the money and so on. There's just games that are too tough. Charlie says, we've got 3 boxes at the company: in, out, and too hard. And a lot of things end up in the too hard pile, and it doesn't bother us. We don't have to be able to do everything well. If you go to the Olympics, if you can run the 100-meter well, you don't have to throw the shot put. Some other guy can throw the shot put, and you'll still get a gold ribbon, if you run the 100-meter fast enough. So we try to stay within the circle of competence. Tom Watson Sr., I think it was Sr. Yeah, Tom Watson Sr. many years ago said, "I'm no genius, but I'm smart in spots, and I stay around those spots." Well, that was pretty damn smart, and we have found a lot of our managers who don't think, they can solve every problem in the world, but they run their businesses extraordinarily well. I mean, you do not want to, Frank Martin mentioned Forest River, you do not want to go and compete with Pete Legal in his business. He's going to kill you, and he's very, very, very good. But he doesn't come around and try and tell us how to run the insurance business, because that's not his game. We look for people that are very good at things they understand, and we don't get any inferiority complex at all about the fact that, you mentioned Intel, I believe. I was virtually there at the birth of Intel because I was on the board of Grinnell, and Bob Noyce was the chairman of the board of Grinnell. And we bought $300,000 worth of their original debentures. And, I knew Bob. I thought he was a very, very smart guy. But I wouldn't have had the faintest idea how to evaluate the future of Intel then. And I really don't have it now, And I think they probably had a few surprises themselves in the last few years with AMD and what's been happening in their business. But what that's going to look like in 5 years, I don't have any idea. And I'm not so sure if you were in the industry, you'd know exactly what it was going to look like in 5 years. Some businesses just are very, very hard to predict. Charlie?
Yeah, one of the foreign correspondents last year, after looking at us carefully, said in effect, "You guys don't seem smart enough to do so much better than other people as you're doing."
Was he looking at me or you, Charlie?
Both. Have you got an explanation? And we said, we know the edge of our competency better than most people do. It's a very useful thing to know the edge of your competency, and I always say it's not a competency if you don't know the edge of it.
I'll have to think about that a little bit. Bill will explain it to me later.
We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood, and to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness. And it's conventional practice, and it may, if all you have to achieve is average, it may preserve your job, but it's a confession in our view that you don't really understand the businesses that you own. On a personal portfolio basis, I own one stock, but it's a business I know, and it leaves me very comfortable. So, do I need to own 28 stocks in order to, have proper diversification? It'd be nonsense. And within Berkshire, I could pick out 3 of our businesses, and I would be very happy if they were the only businesses we owned and I had all my money in Berkshire. Now, I love the fact that we can find more than that and that we keep adding to it. But 3 wonderful businesses is more than you need in this life to do very well. And the average person isn't going to run into that. I mean, if you look at how the fortunes were built in this country, they weren't built out of a portfolio of 50 companies. They were built by someone who identified with a wonderful business. Coca-Cola is a great example. A lot of fortunes have been built on that. And there aren't 50 Coca-Colas. There aren't 20. If there were, it'd be fine. We could all go out and diversify like crazy among that group and get results that would be equal to owning the really wonderful one. But you're not going to find it. And the truth is, you don't need it. I mean, if you have a really wonderful business, is very well protected against the vicissitudes of the economy over time and the competition. I mean, we're talking about businesses that are resistant to effective competition, and 3 of those will be better than 100 average businesses. And they'll be safer, incidentally. I mean, there is less risk in owning 3 easy-to-identify wonderful businesses than there is in owning 50 well-known big businesses. And it's amazing what has been taught over the years in finance classes about that. But I can assure you that I would rather pick, if I had to bet the next 30 years on the fortunes of my family that would be dependent upon the income from a given group of businesses, I would rather pick 3 businesses from those we own than own a diversified group of 50. Charlie?
Yeah, what he's saying is that much of what is taught in modern corporate finance courses is twaddle.
You want to elaborate on that, Charlie?
You cannot believe this stuff. I mean, it's modern portfolio theory, and
it has no utility. But I mean, it will tell you how to do average. But I think anybody can figure out how to do average in 5th grade. I mean, it's just not that difficult. And it's elaborate, and there's lots of little Greek letters and all kinds of things to make you feel that you're in the big leagues. But there is no value added.
I have great difficulty with it because I am something of a student of dementia, and I have.
We hang around a lot together.
And I can ordinarily classify dementia, on some theory structure of models, but the modern portfolio theory, it involves a type of dementia I just can't even classify. No. Something very strange is going on.
Yeah. If you find 3 wonderful businesses in your life, you'll get very rich. And if you understand them, bad things aren't going to happen to those 3. I mean, that's the characteristic of it.
By the way, maybe that's the reason there's so much dementia. If you believe what Warren said, you could teach the whole course in about a week.
Yeah. Yeah, and the high priest wouldn't have any edge over the lay people, and that never sells well.
Right.